market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump is escalating his attacks on Jay Powell, adding to investor jitters over the Fed's independence and the chair's position. Now, since Thursday, the president has taken aim at the Fed chief. In his latest social media post, the president warned that the U.S. economy could slow unless interest rates were lowered immediately, adding Powell would be responsible for any economic slowdown. Now, gold hitting a record on concern that President Trump will fire Powell, triggering a flight from U.S. stocks, bonds, and the dollar. Meanwhile, Narendra Modi and Vance have held trade talks in India, the White House hailing the significant progress, saying the two sides had a roadmap for a possible deal. Now, this comes as Walmart, Target, and other retailers met with Trump to discuss relief from tariffs. And finally, Bloomberg Economics estimates that global GDP may take a $2 trillion hit by the end of 2027 due to tariffs. To unpack all of this, we're very pleased to be joined by Bhanu Baweja, Chief Strategist at UBS Investment Bank, and Brendan Murray, Global Trade Czar. None have slept in the last 3 weeks. Thank you for joining us. Bhanu, I mean, look, there's quite a lot going on, not on only tariffs and the fact that certainly here in the UK they feel deflationary for the moment, but the focus is now on the Fed and what Donald Trump will do with the Fed chair. How concerning is that for markets?
Look, I mean, if it really comes to pass that he does compromise the independence of the Fed, we don't think that will happen. But if it does come to pass that does happen, it's going to make the tariff saga look like a picnic, right? That's a serious problem. You're compromising the exorbitant privilege of the U.S. You're compromising interest rates in the U.S. You're compromising the risk-free rate of the world, the cost of capital of the world. I think they're quite sensitive to the bond market. I mean, the last time when the bond market rebelled against them, it was the bond market, not the stock market, that got Scott Bessent to put a word in Donald Trump's ear saying we really should back off, and he did back off, right? There was a pause on the reciprocal tariffs. So I think they do care about the bond market, and that's why you have to believe, your rational mind really has to believe that they will not go so far as to compromise the independence of the Fed. It's a low probability event. The negative payoff from that is just so high.
Yeah, but Bhanu, is it just trying to find, a boogeyman, basically? Someone
yes.
to
yes, I think that's exactly what it is. I think they understand that this is going to be difficult for growth. They understand that they believe in tariffs philosophically. And if they believe in tariffs philosophically, they are also saying we're ready to take a hit on growth. But of course, it will be nice if you could pin it on someone. And so I think that's the context in which they're talking about it. I don't think you'll seriously compromise the independence. By the way, the markets don't either. So yesterday, the stock market was down. But if you look at inflation break-evens, break-evens were fine. I mean, the 10-year inflation break-even is sitting at 2.3, which is close to the long-term average of the Fed. And there's no real volatility in it. If you're compromising the independence of the Fed, inflation break-evens will go much, much higher. So not just real yields, which are already high because of legitimate fiscal concerns in the U.S. But if you compromise the Fed's independence and you start replacing the 7 governors much quicker than they ought to be replaced, then inflation break-evens will explode higher, and you will see stocks, dollar, bonds suffering at the same time. You're not seeing inflation get hurt right now.
And Brendan, in terms of tariffs, so we have J.D. Vance in India. I mean, this is a crucial relationship. But again, they were allies, but they still got slammed with tariffs. So it'll be interesting to see what happens over the next 48 hours.
Yeah, exactly. So the Trump administration has caused a lot of disruption in markets because of the tariffs that they put in place and the threat of even higher tariffs. So what they need to do now is deliver some deals or the pathway to deals. And I think what you're seeing with India is a step in the right direction. It's a little like announcing your wedding, though. It's a lot of happy talk at the beginning, but then you and your lawyers sit down and hammer out the prenup, and it gets complicated. So I think it's a step in the right direction. We're going to see South Korea in Washington later this week. That's a key trading partner with a lot of automotive and semiconductor industry connections there. The Thai delegation is next, and so we'll have to see if the steps keep going in the right direction, because it just gets tougher from here.
Bernard, what does the U.S. need from India right now?
Well, they need some partnerships on a lot of different things, from energy to things that they're not going to get from China anymore. So I think we're going to, India has traditionally been a very tough trade negotiating partner. The U.S. has found that administration after administration. So we'll see what India brings to the table. But the U.S. is definitely trying to make a U.S.-India trade deal something that they can really go back to other countries and say, look, this was hard from the outset, but we got through it.
Bhanu, what's priced in the markets right now? Because again, there's a lot of maybe deflationary. I don't know whether it's happy talk or because growth actually is really being hit across the world, but the markets are still quite cool about it.
So the markets, I think, are pricing in these tariffs coming straight back down, right? So I mean, if you look at the effective tariff rate in the U.S., it is still 24%. What was announced on April 2nd was 24 to 25%. Today, it is still 24%, and it's distributed completely differently because it's China's 145%, and you've taken down the reciprocal tariffs. But if you look at the dollar amount of tariffs, or if you look at the effective tariff rate, it's still very, very high. Is the market pricing anywhere close to that? No chance. The market's not pricing that because, I mean, if you look at earnings expectations, there's still low double digits earnings expectations over the next 12 months, right? That's unlikely. I mean, if you're going to see this kind of tariff hit, or even if China tariffs reduce from 145% to 60%, the kind of hit you're going to see on domestic demand, right? GDP may be the wrong lens, Francine, because imports are going to collapse, and as import collapses, it reduces the hit to GDP, right? But if you look at domestic demand, that very likely will be in a recessionary state. That very likely will go negative in the second half of this year, and that could mean an earnings stall. So I don't think that's priced.
But so why the mismatch again? And there does seem to be a belief, and I've been told, by people that are close to President Trump, that actually people just don't believe what he says at face value.
So this is exactly it. I think the markets, they sleptwalk into these tariffs because they fundamentally didn't believe that this was an ideological position, and they also fundamentally believed, and I think there is a little bit of inertia in that belief. The market still believes that when push comes to shove, Trump will back off, so they do not expect these tariffs to go through. I don't think these tariffs are priced, or even a much lower level of tariffs like China at 60%. Even that, I don't think it's priced. If you look at global assets, are they pricing in global growth at 2.2, 2.3%, which is where it will be if you have even 60% tariffs in China? No, you're pricing in close to 3.5% growth, so slightly below trend, but trend growth is what is being priced, nowhere close to sort of a domestic demand recession.
Brendan, where are we with China?
Well, the talks are going nowhere. Basically, the two leaders can't agree on the conditions of any sort of beginning of any discussions, and so we're at a stalemate. And at the moment, the U.S. is trying to line up its trading allies. China is warning other countries, don't go against our interests with those alliances. So they're just kind of drifting apart, and that's going to be a real focus, especially this week with the IMF World Bank meetings in Washington. This is going to sort of dominate the headlines from the talks that will take place on the sidelines and in the main discussions among the finance ministers and central bankers.
And Bhanu, does this put the Fed actually in a very awkward position? Because even if they cut rates, is there going to be a reticence to show that they're independent?
Listen, whether you compromise their independence or not, the Fed is in a really difficult position. And remember, we haven't seen this in a long time. Growth and inflation going completely in opposite directions. I mean, this is the kind of stuff we used to see in the 1970s and the 1980s. We haven't seen this. And again, you asked me earlier if the market's priced this. No, the market's not pricing in these stagflationary pressures. What does the Fed do? Well, the textbook answer, and this is what I think the Fed will do, is that when you get a supply-side shock, you do nothing to begin with and then turn very dovish, right? So you are going to see, starting the June print in US CPI, you're going to start seeing some serious numbers, and you're probably going to be at 4.5%, maybe higher core PCE from Q4 of this year to Q2 of next year if these tariffs don't come down significantly. The Fed's it's going to be difficult for the Fed to move until it sees the whites of the eyes of the labor market slowing, which again should happen from Q3 of this year. So we think the most likely time the Fed begins to cut, despite high inflation, is September. So, Trump's been putting pressure that they should go right now. I don't think the Fed is ready to go right now. I think they will have to wait for inflation or the peak of inflation to be seen, labor market to weaken. So I think they begin in September and then they go hard.
What's hard?
So hard is through neutral, right? Over the next 2.5 years, we think the Fed, so we're at 4.5 right now, the Fed gets to 2.25 by 2027. So really a halving of cuts. But what's important is that although the Fed's going to cut, I don't think the long end's going to come in that much because of the degree of fiscal supply and the lack of demand from the rest of the world. The long end actually really lags. So 2.25 decline in Fed rates, probably a 60, 70 basis points decline in the long end.
And Brendan, we also had this report from Bloomberg Economics basically saying, $2 trillion is quite a lot. And again, as Bhanu says, is that at the moment there's probabilities. So the market is also not pricing in things because they're looking for the kind of the backstop. I mean, the range of how much the U.S. economy could suffer is quite broad. Absolutely.
So the Bloomberg Economics marked down not only the U.S. growth outlook for this year and next, but several other major trading engines. What we're going to see, the big date for the real economy is July 2nd. That's when the 90-day reprieve expires. In the meantime, you're going to see companies try to avoid tariffs, try to stop orders. They're going to go through inventories, and there's going to be all this disruption, all this sort of confusion that is not going to give the Fed a very clear picture of what's actually going on. So it's just going to muddle the picture in the next 6 to 8 weeks, and it's going to make the job of the central bank very difficult to get a good read on what's happening with the economy. But so where do you see it first in the labor force? Actually, a disruption.
So initial jobless claims are going to start rising, we think, by late Q2.
Quarter.
Yeah, but no, late Q2, initial jobless claims are going to start rising. By the fourth quarter, you'll see negative payrolls, but payrolls will start declining, we think. Hiring. So as you know, hiring rates have come down, but firing rates have not picked up. So I think firing rates begin to pick up late Q2. Through Q3, you will see weaker payrolls. By the time we get to Q4, you think negative payrolls.
And already we're seeing a lot of chief executives saying, look, they're worried about their spending, right? And so consumption will also be hit at the same time, or?
So consumption was already slowing before the tariffs were introduced. Remember, because we've come from 3 years where the U.S. economy, particularly U.S. consumption, has been on steroids. So that, in any case, you saw the effects of that fiscal stimulus that you saw in the Biden administration, and also the immigration increase that led to consumption going up. So the consumption was already slowing. No doubt, real disposable incomes get hit and consumption gets hurt even more. But also CapEx, right? I mean, who's going to be investing right now? Even if you take tariffs back, there's enough uncertainty out there. Our team has done some numbers which suggest that, first, uncertainty right now is 4 standard deviations higher than normal. Yeah. And our team has done numbers which suggest that every 1 standard deviation increase in uncertainty is 35 basis points hit to the U.S. economy. So it's a serious hit.
Yeah, I mean, I guess what people in finance circles say, Brendan, is that because this is man-made, it can be reversed quite quickly, and that's the hope. Is there any truth in that? Well, there's chatter in the White House that maybe they've gone too far.
Yeah, I mean, there's some evidence over the past 2.5 months that the president and his advisors have their limits. You know, the bond market, for instance, if that starts to show signs of buckling under this cloud of uncertainty. So, I think everything that Donald Trump says you have to take with a grain of salt, and he'll have his pain threshold. It just depends on this is a game of whose pain thresholds are higher, and he has his, especially going into the next couple of quarters. If the real economy starts to buckle, then his political reality changes.
If you do see him backing off, there will still be a minor growth impact. There is no doubt that there will still be a growth impact, but what you hope to avoid is a major inflation impact, right? Because effectively, if you don't reduce tariffs to China, you're going to stop trading with your third largest trading partner. That's a major inflation hit. So what we're hoping is that corporate America can convince the Trump administration, and therefore Trump, to back off soon. And if that happens, then what we can look forward to is that the inflation impact and sort of the dilemma for the Fed is not seen. Some growth impact, I think that's already baked in the cake.
Bhanu, thank you so much. Bhanu Baweja, their chief strategist at UBS Investment Bank, and Brendan Murray, Bloomberg's global trade czar. Now, coming up, tributes pour in for Pope Francis following his death at the age of 88. We look back at the pontiff's legacy next. This is Bloomberg. Well, tributes are pouring in for Francis, Pope, after his death at the age of 88. Italy's Prime Minister Giorgia Meloni called him a great shepherd, while President Trump says he and the First Lady will attend the Pope's funeral. Meanwhile, cardinals will gather soon in Rome to elect a successor. Well, for more, Bloomberg's managing editor for Southern Europe, Tommaso Ebhardt, joins us. Tommaso, good morning. So what actually happens next?
Hello, good morning. I have in front of me the front page of the Italian main newspaper, Il Corriere della Sera, the Pope of the last one. This is how Francis will be remembered, the Pope who arrived from the end of the world, as he used to say. The news from a few minutes ago is that the funeral of Pope Francis will be held Saturday at 10 a.m. In Rome. We are expecting coming to Italy leaders from all over the globe. President Donald Trump, whose stance on immigration was heavily criticized by Pope Francis, will attend the funeral with the First Lady. Macron from France already said he will be here. I was reading Italian media, they are expecting also Zelensky to come to the funeral. So Rome will somehow be again the center of the world at the end of this week for the funeral of Pope Francis, who died yesterday at 88 in the simple apartment he had chosen to live as a pope. His papacy will be remembered for austerity, simplicity, and from his stance being closer to the last one, as the Italian media are reporting today.
Tommy, thanks so much. Tommaso Ebhardt there with the very latest. Now, of course, the spiritual leader of the world's 1.4 billion Catholics since March 2013, Pope Francis hailed from Argentina, making him the first pope from the Americas, as well as the first Jesuit to hold the position. Here's a look back at his life and legacy.
Pope Francis will be remembered as a spiritual leader who encouraged Catholics to embrace more compassionate views on many issues of church doctrine. But his legacy as pontiff will also be marked by his failure to deal decisively with past abuse by clergy. Born Jorge Mario Bergoglio in Buenos Aires, he entered the seminary in his 20s and joined the Jesuit order known for its work on behalf of the poor and for social justice. Bergoglio later became a bishop of Argentina's largest archdiocese and eventually a cardinal before being elected the 266th pope in March of 2013. He captivated many liberal non-Catholics with his focus on poverty and human suffering at a time when far-right political groups were on the rise globally. But Francis's expansive message faced pushback from a polarized clergy and hidebound Vatican bureaucracy. He abolished the highest level of secrecy used to protect pedophiles within the church, yet largely failed to satisfy victims' demands for accountability. He advocated for a freer discussion of homosexuality, divorce, and the role of women in the church, but progressives didn't find him revolutionary enough, while conservative Catholics felt he went too far. He left a final institutional legacy reconfiguring the College of Cardinals that will select the next pope, making it more likely that person will be from Asia or Africa.
Well, with us now is John Studzinksi, Vice Chairman of PIMCO and founder of the charities the Arise Foundation and the Genesis Foundation. John, you're also a very close personal friend to Pope Francis. Now, he'll be buried in a modest grave, turning away centuries of tradition to embrace the humility that we've seen from him since 2013. How will you remember him?
I remember him as someone who, on one level, as your colleague was just saying, lives in the modest apartment. He did not want to move into the 12-room apartment in the Apostolic Palace, which, as you know, it's very grand, marble, it's very cold, it's a bit like a tomb. He thought, what am I going to do there? He lives in the guest house. He would dine and he would be available to have dinner, and there was always the joke in that he would always like to eat off the buffet. So there would be times when we'd walk in, I'd stay at the guest house with him. He'd be sitting in the corner sometimes, and you knew if he was sitting on his own, he wanted to eat and be on his own. But quite often, he would come into the room, he'd see who else was in the room, and if he decided he wanted to be social, he would sit and join them. So he had an element of humility, an element of humor. He loved to play jokes. But also, he had a great sense of humanity and compassion. And I think that's probably more than anything else. That's how he's going to be remembered. The images of him in the first Last Supper, washing the feet, the images of him even last week going to the prison, and of course making the jokes with the prisoners saying, "You're here, they did manage to catch me, otherwise I'd be here." And he had a great sense of humor. And I also saw that humor a lot. He would often talk to me about his meetings with world leaders. And they were always slotted in the diary for 30 minutes. And if he didn't like the world leader or didn't feel comfortable with them, he would find a way to reduce the meeting to 10 minutes. So I always got a sense from talking to him as to which leaders he respected or was engaged with, and which leaders he wanted to reduce their time slot from 30 to 20 to 10 minutes.
And he was tough, actually. He was also tough on some of the world leaders and some of their stances, right?
Oh,
he was quite tough on President Trump and J.D. Vance when it came to deportation of immigrants.
Yeah, I've used the analogy that there's an Old Testament, rather stern, imperial Pope Francis, and there's a New Testament, Christ-like, compassionate, non-judgmental New Testament Pope Francis. And those two coexisted. And depending on the message, depending on the audience, and depending on what he was trying to accomplish. But he knew exactly who he was, he knew where he came from, and he knew where he was going.
John, is there a worry that actually this legacy of compassion, but also being interested in world affairs, putting poverty, I guess, at the center of his focus, is lost with the next pope?
Well, this pope is focused very much on inclusivity, broadening how the Catholic Church welcomed people into it and accepting people. And also, he didn't like people who were indifferent to poverty. I think when we're talking about legacies, we have to be careful. Everyone wants to write his legacy this week. But let's look at the last two popes. It took years for people to appreciate the role that John Paul II has played in history. Pope Benedict, people just originally saw him as a transitional pope, as an administrator, but now he's actually regarded through his writings, and his book Jesus of Nazareth is extraordinary, as probably one of the most important German theologians in 200 years. So you need to give popes and their legacies some time to really understand their impact and what happens. And sometimes we'll see what happens with the conclave. Sometimes conclaves are a reaction. Sometimes they're a reaffirmation.
What do you think will happen? I mean, it's impossible because of the different factions, right? And this pope actually almost came out of nowhere.
Well, he was very much the sort of runner-up candidate at the time Pope Benedict was elected. Now you have 137 cardinals who are able to vote. Canon law suggests there'd be about 120 that would be allowed to vote. It depends what's those factions, what happens in the room. But we do know one thing from the book and the movie Conclave: those who perhaps aspire to it are not necessarily the ones the Holy Spirit accepts.
John, thank you so much for those words of wisdom. John Studzinksi there, PIMCO Vice Chairman, and of course the announcement also of the funeral for this Saturday at 10 a.m. This is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a darkening global economic backdrop has opened the door to quicker rate cuts from the Bank of England. That's as officials eye the impact of Trump's tariffs, a cooling labor market, and tumbling energy prices. Now, markets are fully pricing 3/4 points reduction this year and a 50% chance of a fourth with a cut next month, all but certain. Well, joining us now for an exclusive interview is Greene, member of the Monetary Policy Committee at the Bank of England, and welcome also to our radio listeners. Megan, as always, thank you so much for giving us a little bit of your very busy schedules. Now, markets are now gaining conviction that the BOE will, probably deliver another rate cut next month and more than 3 rate cuts by the end of the year. How comfortable are you with that pricing?
Look, market pricing has moved around a whole lot over the past couple of weeks, and it's also worth pointing out that not all of that is focused on what's going on in the UK. So traditionally, about a third of the moves in the gilt curve have been driven by things happening outside the UK. these days it's about half that's been driven by things happening outside the UK. So part of those moves, I think, reflect what's going on globally. And, we're just about to go into an interest rate round, so we'll have to see. But I would highlight that those market moves don't all reflect fundamentals in the UK.
Because what other uncertainties? If you look at, there seems to be a lot of disinflationary kind of impact from falling energy prices, weaker dollar, tightening financial conditions, global demand. Does that point to a cut, in May?
So look, there are factors that are both inflationary and disinflationary. I'm particularly concerned. We've had weakness in output for about 9 months now, and we're trying to figure out what the big driver of that is, whether it's demand or supply driven. I think there are reasons to think it's both, actually. But I'm more concerned about the supply side, and that actually, on balance, would be inflationary. So that's part of it. When it comes to tariffs and the developments over the past couple of weeks, there, again, are both inflationary and disinflationary impulses. So when it comes to tariffs in particular, for the UK, we're a small open economy, right? The US is our biggest single country trade partner, but the EU, of course, is our biggest trade partner overall. So if you have export substitution, then that would tend to push down on growth and inflation. If you have trade diversion from other countries that are trying to find a new home for their markets, that also pushes down on inflation. But we saw during the pandemic that if you have a repatterning of supply chains, that can push up on inflation. And also if we have trade fragmentation writ large, then that tends to reduce knowledge spillovers, that reduces potential growth. That tends to be inflationary. So something you've mentioned was exchange rates. Yep. And those have not gone as the economic theory would suggest. Normally, if the U.S. announces or imposes unilateral tariffs on other countries, the theory suggests the dollar should appreciate. The opposite has actually happened. And so that in and of itself could be disinflationary for the U.K. But, of course, as I mentioned, the EU is the U.K.'s biggest trade partner, and the euro has appreciated. So net, if you look at the kind of sterling exchange rate index, the pound's up a little bit. There's a ton of uncertainty around this, but there are both inflationary and disinflationary forces.
But are you concerned about the slight recent strength in pound? Does that change actually, tightening financial conditions?
So it does. I mean, the currencies have been moving a lot recently as well. We've also seen off the back of previous kind of structural shift after the global financial crisis, after COVID, the dollar didn't always behave immediately, as the theory would suggest. It weakened and then subsequently rebounded. So I think it's a bit too early to say kind of where the dust is going to settle on currencies. But I will say if the dollar continues to depreciate, on balance, that would be disinflationary for the UK, and if the opposite happens, less so.
So are you worried that, and you said in the past, actually, that there's a danger that it could, muddy the water on inflation, the moves in pounds. So are you worried that there could be a reverse and then it becomes an upward pressure on inflation quite quickly?
It could be. That's right. Currency forecasters have the hardest job, second only to energy forecasters. And like I said, it's been really volatile. We're not quite sure where the dust will settle. If the pound were to strengthen more, actually, then we'll be importing disinflationary forces. If the pound were to depreciate, then the opposite would happen. So it just underscores the amount of uncertainty that we're looking at, given that we are basing our policy now on where we expect the economy to be in a year and a half, 2 years' time. It's pretty difficult.
And how do you see domestic policy actually impacting behavior? For example, the NICS policy in terms of companies, but also consumers.
Yeah, so the combination of the NICS and the increase in the national living wage is something we've been looking at a lot. We've asked companies through our agency network how they plan on adjusting in response to that. And we've also looked at other surveys that have been done. There are a number of different margins of adjustment. So you could, decrease employment, you could decrease hours, you could offer lower wage increases. You could have it eat into profits. You could boost productivity. When we ask firms how they plan on responding and lay those out, they basically say yes. We're going to do those. And so it's a bit too early. It just kicked in April, right? It's a bit too early to say exactly what the margins of adjustment are. So far, it seems like eating into profits will be the most immediate one. But further down the line, it could end up feeding through into kind of labor quantities. And that's a concern of ours, certainly. So we have incorporated the NICS and the national living wage into our inflation forecast. forecast, it pushes up on inflation a little bit by about 0.2 percentage points. So that's not massive, but it is something. But, the big risk, I think, is that there could be a shakeout in the labor market. We could see unemployment tick up. There are no signs of that yet, actually, even though the NICS and the national living wage have come to be. So it might be a bit too soon. We see in the kind of forward-looking PMI employment indices, they were really falling before. They weren't performing well, but actually in the most recent one, they've ticked up, which suggests a lot of that was around kind of sentiment around the NICS rather than actual expected behavior.
But has the labor force dynamic changed, actually, for the worse since 2020?
Since 2020.
COVID.
Yeah, I mean, what we've seen is that the labor market has held up surprisingly well in the UK as it has across developed economies, right? So we have unemployment of around 4.4%. That's pretty low. I should provide a big health warning with our labor market data because the labor force survey hasn't been getting as many responses as it did pre-COVID. And that's been the case everywhere, but especially so in the UK. So it's hard to get a real read on the labor market. That said, we look at a bunch of other indicators and series. We have our own kind of indicator-based models, and underlying employment is growing pretty slowly. Unemployment, is ticking up very slowly. We've seen the labor market weakening since COVID, slowly, again, not as quickly as one might have expected, and wage growth remains pretty high. Now, that's wage growth according to the labor force survey again, and it's pretty volatile and actually ticked up at the end of last year. It's since started to come back down. But if we look at other metrics of wage growth, they're also pretty high. And that's important because that's a huge input into services inflation, which tends to be more domestically driven. And so that's something that we're looking at a lot. Services inflation in the UK is around 5%. It's much higher than other developed economies. And that's a sign that maybe there is some inflation persistence in the UK economy.
I was going to ask you, what part of the UK inflation spectrum are you most worried about? Is it services or private sector wages?
So I would say I'm more worried about services inflation. It actually has surprised on the downside more recently, and I should highlight that the disinflationary process is underway and continues to be underway as we see it in the data. I'm worried about services inflation, as I mentioned, because it is an indicator of domestically driven inflation, which we can actually do something about. It's the biggest contributor to inflation in the UK. The biggest part of it is actually pay growth, which is why I'm also focused on wages. But one factor that feeds into wage growth, of course, is inflation expectations. And we've seen household inflation expectations rise. And that goes for both short-term measures and medium-term measures. The latter is a bit more worrisome, actually. You don't usually see those rise. So I think they remain well anchored. We've looked at kind of the relationship between inflation expectations and the economy pre-COVID and come up with kind of bands of reasonable inflation expectations now. And where we are is within those bands, but towards the top of it. So it is something I'm looking at as another sign of inflation persistence.
Everything seems to, it's changing so quickly and the markets are changing so quickly. Is there anything that that you can confidently say will not change?
That won't change. That we'll have a lot of uncertainty for a while is one thing. I mean, there is a lot of volatility. The markets haven't actually really responded as you would expect in the face of a risk-off environment and that amount of volatility. And so that does inject quite a lot of uncertainty. And there's, policy uncertainty coming out of the U.S. as well.
I mean, I was looking at the 30-year borrowing cost for the UK, around 5.35%. I mean, it's the highest they've been this century. Is that a message to policymakers from bond vigilantes, or how do you see this?
So it could be, but it could also just be a reflection on what's happening in the U.S. in particular and a read-over. That's what we've seen since COVID, is that there's just significant read-over automatically, even though the structure of the U.S. and the UK economies are quite different. Because the UK is a small, open economy, it does get dragged around by developments happening elsewhere.
Yeah, how much, I mean, we're trying to theorize about what the Fed does and when they can start cutting if labor goes down in like the third quarter. Is that when they start cutting aggressively? But what's your path for interest rate cuts in the next, 6 to 8 months for the Bank of England?
For the Bank of England. So I have been on the more cautious side of our rate cutting cycle because of all these indicators that there could be inflation persistence. There's also uncertainty. I do think there are risks on both sides, though, actually. So I'm also careful in our lingo. I think that the tariffs actually represent more of a disinflationary risk than an inflationary risk, though. And so we'll have to see how that develops going forward.
Is there anything that actually, I mean, first of all, is it so difficult to know where the current neutral rate is? Yes. Do you have an idea of where it is? Because that'd be good to guide the markets towards that.
Yeah, as you know, we use a lot of different methodologies to try to estimate the real neutral rate. We use financial markets indicators, we use surveys, we ask investors, we use macro models, and they all have massive bands of uncertainty. So I won't give you a point forecast. In February, we put out kind of our analysis on this and showed that depending on which methodology you use, the long-run neutral rate has probably gone up by between 25 basis points and 150 basis points. So that's a pretty wide band. But what we can conclude is it's probably gone up, and this is something I've believed for a while. So I think it's higher than where it was. When we ask investors, they say somewhere between 3.25 and 3.5%. I don't think that's totally unreasonable.
Megan, is there any case that the UK has a competitive advantage with the tariffs? Because given they're at a baseline 10%, which offers, I guess, more certainty for businesses than in the EU where they're still negotiating.
Yeah, so again, we'll have to know when the dust settles, but the EU was given a lower tariff rate than many other countries. And so that does end up being a bit of a competitive advantage, particularly with respect to the EU. So we'll see what happens with the EU tariffs. But if the UK does end up with lower tariffs than the EU, then you might have some kind of substitution. So actually, normally trade diversion, you think of it as disinflationary for the UK, because you think of, for example, products coming from Asia looking for a market, them offering lower prices to find access to the market. But actually, you could get trade diversion from the EU because the UK has lower tariffs. It all depends on how much substitution there really is.
When you look at the complex over the next couple of months, is there a point where if tariffs come down with, say, China or India, does that give you hope for a more settled economic backdrop worldwide, or is it still going to be messy?
So I think there's going to be a lot of volatility in terms of policymaking regardless. I don't expect us to know exactly what the global trade landscape or financial landscape will look like anytime too soon.
I know we led the show actually talking about central bank independence because of what Donald Trump was saying about Jay Powell. I mean, as a central banker sitting on the MPC, how does the BOE react to this?
So, credibility is the currency of central banks, and I think independence is quite an important piece of that. That when we say we will hit our target, and the target for the Bank of England is provided by Treasury, but we will hit our target. I think we can do so credibly because we're free to make the decisions that we believe will most effectively achieve that. And so I think central bank independence is absolutely crucial.
Megan, thank you so much for joining us today. That was, of course, Megan Greene, member of the Bank of England's Monetary Policy Committee, joining us for an exclusive conversation. Now, coming up, Tesla reports today investors will be keeping a keen eye on performance as questions are raised over Elon Musk's role with the federal government. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that the U.S. will hold talks in London tomorrow with Ukrainian and European officials in the latest push to halt Russia's war. Now, the U.S. Secretary of State, Marco Rubio, and Trump's special envoys, Steve Witkoff and Keith Kellogg, are expected to meet with the foreign ministers from France, Germany, the U.K. and Ukraine. Now, on the ground, Russia has resumed military operations in Ukraine after an Easter truce expired. Now, Harvard University is suing the Trump administration for freezing billions of dollars of federal funding. Well, Harvard's president says the freeze happened after it refused to follow what it calls illegal demands to make changes to governance, discipline and hiring policies, as well as diversity programs. Well, President Trump has accused Harvard of failing to combat anti-Semitism on campus. And Bloomberg has learned that Nomura has agreed to buy Macquarie's U.S. and European public asset management business for $1.8 billion. The deal marks Nomura's most significant overseas acquisition since it bought Lehman Brothers assets back in 2008. Now, the transaction is part of the Japanese firm's efforts to diversify away from its domestic market and trading operations, and appears to be a big bet on the future strength of the U.S. market. And shares in Novo Nordisk slumping this morning. That's after a pill from rival Eli Lilly helped patients shed weight and control blood sugar, about as well as it injected blockbuster Ozempic. Now, the news from Lilly puts pressure on Novo, whose market value has dropped by a third since the start of the year. It's now fallen to become Europe's fifth biggest company by market cap. Now, a host of Europe's largest firms report earnings this week. We'll be looking ahead with Bloomberg's Charlie Wells in a moment. But first, Tesla reports first quarter numbers later today. The EV maker faces questions about volumes, autonomous driving, and tariffs. All the while, the chief executive, Elon Musk's role in the White House, looms over the company's future. So for more, let's bring in Bloomberg's global autos editor and Elon Musk expert, Craig Trudell. So, Craig, thank you so much for joining us. I mean, there's so many people, and actually, whether it be insiders or shareholders, saying Tesla's not doing great because he focuses so much on the government and Doge that he's really keeping his eyes off the ball.
Yeah, I think it's sort of reminiscent of a few years ago, right, when he decided to buy Twitter, now X, and that became such a huge issue for the company that the level of attention that he was paying, or lack thereof, was really sort of front and center. I think it's similar in this case, but also, at least in the Twitter case, he was still pursuing business as opposed to politics, and so you could quibble with his leadership of Twitter, and yet you could sort of take or leave whether you really wanted to care about that or not. I think it's a whole different matter when your vehicle becomes a political object, and whether or not you want to sort of buy into that as someone looking at buying a new car. But
Craig, so is the problem that he's basically too political, or that he also doesn't have anyone to take his role at Tesla?
I think that's also an entirely fair question, because some of the folks who sort of push back against this notion that this should be such a front and center issue say, well, no one buys a car based on the CEO of the car company from which they're buying. But, there isn't a car company out there that is so synonymous with the CEO as Tesla. And so this is indeed an issue of how do you sort of, separate, the company from the CEO, right. And, is there, anyone waiting in the wings? I think we did see in the past, after that Twitter saga, Tesla staged this event where they had, something like 15 executives sort of line up alongside Musk, for an investor day. We haven't seen that sort of effort to kind of, demonstrate the bench behind him. Maybe we'll see that again from them this year as a result of all the concerns about his leadership.
But Craig, he has tried to basically say, look, don't worry about the concerns about Washington. I've got this. But it hasn't quite worked out.
Yeah, and I think a big concern that you have is, yes, the refresh Model Y is coming to market. That's starting to ramp up, and that may allay some of the concerns about the brand damage that he's doing. But what do you have other than that? The Cybertruck is not proving to be the sort of big seller that Musk thought it would be. And, the Model 3 refresh did not do well whatsoever. The Model S and X are really long in the tooth. There's also, concerns about whether or not you have a sort of more affordable model waiting in the wings, which is something that, a year ago the company was touting, and there have been reports just in the last couple of days that those may actually be delayed. So if that is the case, you really have an issue of it's not just first quarter weakness sales-wise, that bleeds into this quarter as well.
Craig, elsewhere in the EV space, CATL is also unveiling innovations in batteries. That feels like a big deal.
Huge deal, and this may be something that Tesla is able to take advantage of, in that they are a big CATL customer, but it's not necessarily a distinguishing feature, obviously, right? If CATL is selling these batteries widely, and you do have this really impressive fascinating sort of one-upsmanship going on in the Chinese market, where just a few weeks back, BYD was drawing a lot of attention for its 5-minute batteries that charged up with 400 kilometers of range. Now you've got CATL coming in soon thereafter saying, well, we can do better than that, even more than 500 kilometers. So this is really a case where, the innovation we used to think of Tesla being on the leading edge of that. Now it's really the Chinese that are out in front in terms of the electric vehicle space.
So interesting, Craig. Thank you so much, Craig Trudell, there with the very latest, of course, on Elon Musk and CATL. Now, Europe's largest firms also continue to report earnings this week. SAP on deck for later today as trade tensions raise questions over the company's forward guidance. Well, Charlie Wells is here to talk us through some of the earnings reports. So L'Oreal shares, let's start with a bit of beauty. You know what? Why not? It's Tuesday morning. Those shares gaining this morning. What's behind it?
Yeah, Francine, it's kind of a welcome back from that long holiday weekend, and L'Oreal reported better than expected earnings for the first quarter, and they saw a real jump in their Luxe division. And now that is kind of representative of the power that the higher-end consumer has had across the globe. And I think going forward, the question will be, will they be able to propel this company and other consumer companies? But certainly the answer today, as we're looking in the markets, is very positive. And if you think back to those L'Oreal earnings, what was really striking were like-for-like sales, up 3.5% in the quarter. Compare that to the estimate of 1.3%. So a significant jump there. Great story in the market for that business this morning.
So what are analysts expecting from SAP?
So look, this is Europe's largest company. And I think, we're talking about Tesla, we're talking about tariffs. The question is, how does European tech respond to tariffs, right? Because that story has not been good for the tech sector so far. SAP has been a little bit insulated because they have this longer-term trend of customers moving from on-premise, very licensed technology to cloud-based, more subscription-style technology. That's insulating them a little bit. They're performing not great, but a little bit better than their peers in Europe. Does that continue? How much runway does this have? I think that's what we're going to hear about on this call later today. Okay,
and then we have the European banking season. Craig can't wait. He's so happy he's in cars and not banks. BNP kicking off. They're reporting it on Thursday. What can we expect?
I mean, look, it's sort of like the European Champions League is starting up. And basically, I think, is it going to look like what we saw on Wall Street? Are we going to see this trading boost that we saw on the back of the volatility that we've seen over the past couple months? Or do we see a different story start to emerge on some of these tariff concerns, on this uncertainty? Thinking about BNP reporting on Thursday, their loan loss provisions are ticking up very significantly. That hits into profitability. And so they've also got this, large trade finance unit, which, helps facilitate commerce cross-border that is under attack right now.
Okay, what about pharma? So we also have Roche on Thursday. It's like, it's like a marathon of earnings.
It really is. And so many of these huge themes, right? So with pharma, we've got cross-border. We've got Trump talking about how he wants to bring in sectoral tariffs. Forget the country specific. We've got these sectoral tariffs looming over European pharma. And, Roche is reporting on Thursday. That's going to be really interesting to see because they have just announced $50 billion in investment in the United States. How do they kind of communicate that message over the course of this earnings call?
We had a great conversation also with Baweja of UBS, basically saying that even if President Trump walks back some of the tariffs, it's still going to hurt growth, and therefore it will hurt earnings per share. What are you seeing happen in Europe?
I think that's the concern about the consumer, right? I think that can the consumer, if we think back to L'Oreal, continue to propel some of these, more discretionary companies? If we think about a softening economy, how does that impact banks, for instance? Thinking about BNP, thinking about the fact that rates have just been lowered, that could create an environment where the lending that these businesses, that these banks have been bringing in is softer than it's been over the past few quarters.
All right, so thank you so much, Charlie Wells, there with the very latest, of course, on earnings. We'll be watching for Tesla a little bit later on as well. Now, there's a lot going on in the markets. First of all, U.S. stocks set to bounce back from yesterday's losses that were pretty violent. Investors weighing progress, of course, on trade talks, for example, in India, but also a lot of focus on these Tesla upcoming earnings. A couple of other things I need to watch out for is gold actually topping 3,500 for the first time ever. Again, market volatility driving haven flows also into yen. The yen strengthening beyond 140 per dollar for the first time since September. Up next, it's Bloomberg Brief, and this is Bloomberg.